Hello, everyone. Welcome back to Financial Clarity for Doctors. This is Rachelle Vanderzanden here with Corey Janoff.
Hello.
Welcome back. We're here again. So are you, which is lovely. We wanted to talk a little bit today about charitable giving and how you can do that in ways that may be beneficial to you for tax planning purposes. And this is generally applicable if you're getting giving pretty large chunks of money. Like that's the only way that it's generally going to have a big benefit for you tax wise. But there are some ways that you can do this that are fairly simple. There are other ways that you can do it that are very complicated. There are some tax deductions that you can potentially get for yourself now. There are some that are more applicable if you're trying to avoid estate taxes at like the end of your life. To be clear, estate taxes right now are only really relevant for people who have very large taxable estates, but those rules and laws change over time. So it could be more applicable for people who even have smaller estates in the future. But we're going to do a little overview. As always, like this is informational in nature. When you are actually thinking about implementing things like this, it is very helpful to talk one-on-one with a financial advisor, potentially an accountant, especially if you're trying to get tax deductions right now, and even an estate planning attorney if you're planning some end of life gifts and things like that. So, we're going to give a general overview of some of those things you can do now, some of the things you can do later, and kind of try to point you in the right direction a little bit.
I guess on the estate tax side, federally, unless you have a very large estate, it's a non-issue. At the moment, laws could change. Every
Isn't
40.
it like 15 to 16 million dollars per person and like 30 if you're a married
It's
couple,
yeah, it's I
basically?
think
It's
just under
enormous.
30 for a married couple federally,
Right.
which is the highest it's ever been. Um,
Right.
and that could go lower in future
Yep.
regimes, depending on what tax laws look like. Um, and that could change this year potentially. Like there's going to be some tax changes because the current tax code is set to expire at the end of 2025. So you're probably going to, especially as we get into the back half of this year, start to hear more chatter on the new tax proposals and what ultimately gets written into law. Um, I would speculate probably not a whole lot's changing just because the current tax plan was implemented by the current administration the last time they were in.
Hmm.
But in the future, that could change. But at the state level, depending on which state you live in, like Rochelle and I are in Oregon, if you're worth more than $1 million when you die, you got to pay some state estate level taxes. Say that 10 times fast. State
State,
estate.
estate, state,
Yeah.
estate. I got two.
So the state of Oregon taxes us, even though we may not have to pay federal taxes. So a lot of people will try to make some moves to minimize their estate value to avoid those state level taxes, which will vary from state to state. And most states do not have estate taxes. But I think there's maybe nine or a dozen or something that do have a state level tax when you die.
Yep. Worth looking up.
Let's see, where do we want to start here, Rochelle?
Yeah, I think we are going to talk a little bit about some things we can do now, some things you can do later. We're going to talk a little bit about thresholds for like itemizing on your taxes and how you can be strategic about your donations to maximize those itemized deductions. We're going to talk a little bit about like donor advised funds and foundations and trusts, some things that are maybe a little bit more complicated but can have some long-term benefits. But I think just to start, it's helpful to talk about how can just charitable contributions in general help you with your tax return right now, like this year's tax return or next year's tax return. So I think one thing that sometimes we miss is that really we can only deduct charitable contributions or they're only valuable to us if we are itemizing on our tax return, our deductions. And the standard deduction is fairly high right now and has been since the Tax Cuts and Jobs Act was passed quite a while ago. And it was kind of intentional. It was like, hey, if we make the standard deduction higher, then people don't often have to itemize as much. So maybe this will make things a little bit simpler. So the in 2025, the standard tax deduction is $15,000 for people who are single filers and $30,000 if you're married filing jointly. That basically means that unless you have more than that of itemized deductions, you just take the standard deduction because it's more valuable to you. So if you were a married filing jointly couple and you have less than $30,000 in itemized deductions, you're not itemizing. Your charitable contribution didn't help you in terms of your federal tax return. Your mortgage interest didn't help you in terms of like your federal tax return. And that's okay. It just means that that standard deduction was larger. So why not take that? So, for some people, if you are planning to give on a regular basis and like there's a certain chunk of money or a certain goal of giving that you have per year, let's say it's like $10,000 per year that you'd like to gift, you can consider doing multiple years worth of gifts in 1 year to try to like put them in 1 year so that that itemized deduction is more valuable to you. So we'll walk through just one example, but let's say you naturally have $20,000 in itemized deductions, whether it's like mortgage interest, state and local taxes, anything else you can potentially itemize. And you usually gift about $10,000 per year. So if you do 1 year's worth of gifts and you have your other itemized things, that adds up to $30,000, which is exactly the same as the standard deduction. So it's not actually saving you any money to do that. But if you change your strategy a little bit and you're like, okay, like we have the cash flow or we're comfortable enough to be able to do $20,000 worth of charitable gifts this year and we're just going to skip them next year. Now you have $40,000 in itemized deductions, which means that's $10,000 higher than the standard deduction. So you are reducing your taxable income by $10,000 by doing that. So you can try to be strategic. If this is something that you want to do on an ongoing basis, even if you don't have the cash flow to do it this year, maybe you don't do any charitable deduction or contributions this year and you save them all for next year and you do all of them next year. However, it makes the most sense for you. And then do keep in mind that like how much you can itemize or how much you can reduce your taxable income by charitable contributions is limited. This is where we start to get to the point where it's like you should talk to an accountant if you're trying to be very strategic about this and do things in the most beneficial way. Because there is such a thing as like gifting too much and it's not necessarily helpful to you right now. So keep all those things in mind and try to be a little cautious and careful and analyze your options before you do it, all of that kind of stuff. Run the numbers.
Yeah, I think a common misconception is, oh, I give to charity, it's going to lower my tax bill. Well, not always, only if you itemize.
Yep.
Um, Another simple and relatively easy strategy could be a little more complicated depending on the charity and the where your investments are held at, but gifting appreciated stock or appreciated investments. Um, Most especially larger charities will accept assets rather than cash. And you can give them stock that they could then sell, or you could even potentially give them real estate. Like, depends on the charity, but some will accept appreciated assets instead of cash. And that can be valuable to you from a tax avoidance standpoint. Because if you have investments that are worth more today than when you bought them, if you were to sell those investments and give the cash to charity, you would have to pay capital gains taxes on the proceeds from that sale. So you'd be better off just giving the investment to the charity instead. The charity doesn't have to pay capital gains taxes when they sell it. So it's a way for you to get the same tax deduction, but avoid paying capital gains on those assets. Now you might think, well, I want to keep my investments for retirement. I need that money. Well, let's say we have a decent amount in cash. We have a decent amount in our taxable investment account. Your original plan was just to give cash to the charity, whatever number you want to throw out there, 10,000, 20,000, 50,000, doesn't matter. You could take that equivalent amount from your taxable brokerage account, find whatever your highest gain or lowest cost basis positions are, transfer those shares to the charity, and then just replenish your investment account with your cash. And that will reset your cost basis to whatever the current value is when you repurchase that investment. And you've gotten the tax avoidance, you've gotten the tax deduction from the charitable contribution, and you've avoided the capital gains taxes on those assets as well. So it is a little more complicated than just giving cash. You got to get multiple things involved. There's probably some paperwork to transfer to the charitable
Hmm.
organization. They have to accept it, but especially if you're dealing with larger amounts, that can be potentially worthwhile. If you're just going to give $1,000, probably not worth the hassle. But if we're talking like, hey, I want to donate $100,000 to this charity, and I bought Nvidia stock 4 years ago for $10,000, and now it's worth $100,000, well, maybe we just give them our 100 grand worth of Nvidia stock and avoid the capital gain on that $90,000 of growth that we've yet to realize, and then can avoid taxes on it. So win-win for everyone.
Yeah, absolutely. I like those like win-win-win sort of situations. One other way you can potentially help with tax planning is just through charitable bequests, which is kind of like end of life planning. If in your will you say, hey, I would like to give X amount to this charity, that amount will be subtracted from the value of your estate for estate tax calculation purposes. So this is not about income taxes. It's about that like passing assets to the next generation. Like if you're going to give money to charity, like it can be a good way to reduce your taxable estate. Just as an example, like let's say your estate is valued at $2 million, and in your will you write that you want 50% of that donated to XYZ charity. Like then the rest of the estate goes to whoever else you have decided to like leave that money to. That $1 million goes to charity and isn't taxable. The other $1 million, for example, if you're in Oregon and your taxable estate over $1 million is taxable, now your estate is only $1 million. There's no estate taxes. So, lots of different ways that we can consider gifting money if that's part of the plan and doing it in a way that has the most tax benefits for us and our families.
So the end of life giving doesn't really benefit you today. It benefits your
Hmm.
heirs from,
Yep.
well, I guess and it also doesn't really benefit them either because they'd be better off just receiving the full amount, net of the taxes versus, in that, because the tax rate,
Yeah, but if you wanted
I
to,
know.
like, if you don't want them to have all your money, like,
Exactly. So it definitely reduces the estate complexity if you don't owe any taxes. So
yeah,
so I guess kind of an overall, taking a step back here. If you're charitably inclined, you want to give to charity, hopefully you're doing it because you want to help others in need, you want to make the world a better place, etc. You're not only doing it for the tax deduction. It's like, hey, this will help
absolutely.
lower my tax bill. Couldn't
Yeah.
care less about the charity. I just want the tax savings. Well, the math is doesn't math then. Like you'd be
No, not
better
at
off
all.
just keeping the $100 and
And
paying an
paying
extra
taxes.
40 in taxes on it than giving $100 away and not paying 40 in taxes. Like you're
Yeah.
$60 better off if you just kept the money. So I mean, I think most people are giving to charity because they want to, and oh, there's an added bonus of the tax incentive. So let's find a way to get the most tax benefit we can, whether that's, lumping
Yeah.
our contributions every other year to itemize um, or doing some of these other tax efficient strategies we're about to discuss here. But but yeah, if you're only giving to charity for tax purposes, it's kind of like the argument, oh, I'm buying a house to save on taxes. Nah, let's not do that. It's going to cost you a lot more than you're going to save.
Right.
So,
Or I'm going to make less money so that I don't have more in this higher marginal income tax
yeah,
bracket. I'm like,
I'm
just stop.
I don't want my year-end bonus because it's going to push me into a higher
No,
bracket. It's like, no, take the bonus. You're still better off, even though you're
get
paying a little
money.
more in taxes.
More money is always better.
Yeah, all else equal, more money is better. Um,
Okay.
let's see. So, more complicated strategies.
Oh
Donor
yeah,
advised funds, Rochelle.
I like that one. This is like the medium complicated option, maybe. But a donor advised funds allows you to make a tax deductible gift now without necessarily deciding where you ultimately want that money to land. So if you know, like, hey, I'm in a like super high tax bracket this year, I have lots of extra cash flow. I know that eventually I will want to gift this money and I do not need it right now. Like you can donate a big chunk and put it into something called a donor advised fund. And that allows you to give yourself more time to decide where that money might end up eventually. That money can be invested inside of a donor advised fund. You can kind of control how it's invested and managed. There's lots of different places that you can do it. Like we do it here for clients sometimes. People like Fidelity and Vanguard and places like that can do donor advised funds as well. And then eventually you can decide like what charity you want to give that money to, when you want to give it, how much you want to give it. It doesn't have to all go to one charity, but you can potentially lose some amount of control um, over like how that money is managed and where it goes and things like that. But the other thing is that, using the example of like highly appreciated stock, like you can gift that money to a donor advice or it like that stock or like whatever appreciated assets, whatever it is, whether it's stock or mutual funds or anything like that, you can gift those things to donor advised funds as well. So knowing like, hey, I don't want to pay $90,000 or like taxes on $90,000 of capital gains. I would like this to be donated to charity at some point. I don't know exactly where. You could move it into a donor advised fund and then, then it's there. Then you don't have to pay taxes on that capital gain because it's officially been donated.
Yep, yep. Yeah, donor advised funds are a great way if you're someone who just wants to regularly give money to charity, but you don't
Hmm.
really have the time or the mental capacity right now to figure out which charity you want to give it to. But it's like, hey, I want to donate every year. I'm just going to set up an auto contribution to my donor advised fund, and then eventually I'll get around to deciding on which charities to ultimately give that money to once it's a larger balance and
Yep.
potentially more meaningful at that point.
Yeah. And then in the meantime, you can let it grow, which is great.
Yep. Um, Private foundations. These ones are more complicated. Don't know too many people personally with them. I've got a couple clients, but
Hmm.
common amongst more wealthy individuals, which hopefully you will all be in that boat at some point. Um, Essentially, you're setting up your own nonprofit entity to run and operate and benefit the community some way, somehow. They're definitely higher administrative costs than a donor advised fund or simply just giving the money to another charity. It's its own legal entity. It's essentially its own business or charitable organization almost. Um, More public scrutiny. You got to report things and file things and tax filings, etc. But if you have significant assets, long-term goals, make a high income, want to do the administrative work, or in reality, hire people to do the administrative work, you're going to have employees running the foundation for you. Um, you can gift pretty significant amounts of money in a tax deductible manner, and the investment gains on those assets are essentially nothing. So you're allowed to deduct up to 30% of your income every year on gifts to a private foundation, a charitable foundation. Um, so for simple math, if you're making $1 million a year, you can give up to $300,000 tax deductible. If you wanted to give more than that, you just wouldn't be able to tax the additional amount. But um,
Hmm.
and then the foundations, they pay a capital gains rate of 1.39% of their net investment income, which I'm presuming simply is just whatever their investment earnings, realized earnings were minus their expenses. So essentially nothing is what they pay taxes on. So you can donate to this foundation, grow the foundation over time. The foundations must distribute at least 5% of their assets per year. So it can essentially be a multi-generational thing that you're establishing here. Hey, we're going to fund this, distribute 5% per year and let this thing run for decades, centuries to come to benefit whatever you're trying to benefit. And they're great for supporting causes that may not necessarily be 501c3 nonprofit organizations that you can just give money to and get the tax deduction. For example, you see pro athletes often do this. They want to sponsor youth sports programs in their community for underprivileged children who can't afford equipment, registration fees, etc. So they set up the leagues. It's no cost to the kids to play. They provide all the gear, etc. You could do something like that for your community for something that's important to you. Um, and just normally that wouldn't really be a nonprofit tax deductible donation. I mean, maybe the local Parks and Rec department that runs some of the leagues is a nonprofit, but not necessarily.
Hmm.
So it's kind of a way, again, requires more capital, more administrative work, more manpower, but gives you more control of how that money's used, when it's dispersed, how it's dispersed, who it goes towards, et cetera. And, you know, good for PR too, if you're doing a good job. Now, if your administrative team is stealing money from the foundation, probably not good for PR, but yeah, anyways.
Yep. Foundations can also be very, very small. Like maybe it's, I don't know, it can be like setting up a solo 401k or something where you have some sort of administration that's happening behind the scenes, but not necessarily like a multi-million dollar foundation. Like maybe it's 100 or $150,000. But again, a little bit more complicated than something like a donor advised fund. And at that level, it may not be necessary and maybe like more work than it's worth. One other way of potentially gifting money at especially like end of life is through something called a charitable remainder trust. And this is where it's like, let's talk to an estate planning attorney, and you should probably do that. There are so many different kinds of trusts, and it can be very complicated. But a charitable remainder trust is one kind of trust where you can set it up and you can fund it. You could deposit like a big chunk of money in there. You can use it to generate income stream for you now. So you can take income out of that trust while you are alive. And then when you pass away, the remainder that is left in that trust is given to some sort of charity that you've already determined through the trust. It is an irrevocable trust, which means once you have set it up, you cannot change it. It is what it is. Like, you can't be like, just kidding. I don't want to give money to that entity any longer. There are very strict rules. You can get a tax deduction on the present value of future estimated gift to the charity. So you can be like, okay, like if this has been invested for this long, how much do we think it's going to be worth? Let's take a tax deduction for that. But just simple incorrect math as an example, let's say you donate $1 million to a charitable remainder trust and set it up, and you plan to receive $50,000 per year and you plan to remain alive for 12 years. Like we have to estimate all these things we don't really know.
It could
That
just
would be
be a set number of years it's being distributed, like I'm gonna
right.
get,
Maybe at that time it ends.
yeah,
Yeah,
hopefully I'm
for
still
sure.
alive, but I'm taking distributions for 12 years and then the rest just stays.
Yeah, so that would be like $600,000 total that you have taken as distributions, which means you have 400,000 that is remaining and goes to charity. And so therefore you get that $400,000 tax deduction now. In reality, like hopefully it'll be more than $400,000 because hopefully that money is invested and it can grow a little bit. So maybe it's yeah. So it could be all sorts of different numbers, but there's lots of ways to set those up, lots of conversations to be had with attorneys in order to set it up. But that can be a really good option just to have a way to keep some income now, but also have a plan for gifting that money in the future.
And I think again, it's worth repeating pretty strict rules. It's an irrevocable trust, so you can't change anything after it's set up. It's a fixed, predetermined income stream that you're receiving. So it's not like you're going to say, "Oh, I'm going to take 50,000 this year. I feel like I need 70 next year. I only need 30 the year after." No, it's like, here's what you're getting. There's no changing it. So if you need more than that, too bad. That's what
Hmm.
it's designed for. So, but it's a way for you to, one, get these assets out of your estate. So for, asset protection purposes, reducing estate value for estate tax purposes, it's out of your estate. It's in a separate irrevocable trust. You can still live on the assets. It's going to spit out that income, or not, maybe income's the wrong word. It's going to spit out that set amount to you every single year. You're giving money to charity when you die. You get a bit of a tax deduction today. The present value calculation, that's what Rachelle is like, the math is incorrect because it's a whole formula for calculating the present value of the anticipated future value of that money. So it's not as simple as, oh, I'm giving $1 million, I'm taking out 600K, so 400 is going to charity, therefore I get a 400K deduction. It's not quite that simple, but you get the idea. Um,
Hmm.
let's see. Lastly, other types of irrevocable trusts. So these ones aren't really going to necessarily get you a tax deduction today, but it's more just getting the money out of your estate, out of your name, so that when you die, it goes to wherever you want it to go to, and the value of your estate is lower for estate tax purposes. So your heirs receiving whatever's left in your estate hopefully are avoiding some taxes as a result. Uh, And like the money that's out of your estate in these irrevocable trusts, like it could go to your kids, it could go to grandkids, it could go to nieces, nephews, friends, whatever. It doesn't have to be charitable. By getting it out of your estate, you're avoiding the estate taxes on that money. Again, generally these have to be irrevocable trusts to be out of your estate. So once you set it up, there's no changing it. If you set it up to give money to your grandkids and your grandkids turn out to be drug addicts, well, I guess you're supporting their drug addiction with giving them all that money. But there's ways to put provisions in there. It's like irrevocable trust goes to the grandkids unless they're drug addicts. Then it goes to this, dog shelter. Um, so like you can put some stipulations in there so that
Hmm.
you still exercise some control over it even after you're gone.
Yeah.
But but yeah, it's kind of that get a tax deduction now and totally lose control over the money because you've given it away, or plan to avoid estate taxes later and still exercise some control. But yeah, be as tax efficient as possible with your charitable giving, especially
Hmm.
if you're thinking large amounts. If you're just giving a few $100, $1,000, probably not worth the hassle of jumping through any hoops. But if you're thinking of sizable gifts or want to plan to make sizable gifts in the future, you're like, hey, I'm making a good income, I'm saving a lot, I'm gonna have way more than I need in retirement. Is there anything I can do to start thinking about these future gifts that I might want to make and potentially benefit from a tax standpoint along the way?
Yeah. I do think that's one kind of important thing to think about a little bit when you are planning. So if you expect that you will have much more money than you need, it can potentially make a lot more sense to gift money now than later. Like it could, especially if you're still working and earning a very high level of income, like those tax deductions now may be a lot more valuable to you, and those donations now may be a lot more valuable to whoever you are donating money to. Like it can go both ways. So again, this is for folks who are wanting to do this already. I expect that if you're listening to this episode, it's because you're actually interested in like, charitably giving, but do it because you want to gift money, not just because you want a tax break, because it will cost you more money in the long run if you're doing it just for the tax breaks.
Yep, yep.
Yeah.
Yeah, getting those deductions, like Rochelle said, in your peak earning years, probably more valuable than waiting till you're retired to get the
Yep.
tax deduction. So,
Absolutely. Yeah. Well,
all
thank you
right.
for listening, everyone.
We'll see you next time.